if you want to get the guess game out of what stocks to buy to grow your portfolio, I'm going to talk to you today about ETFs, exchange traded funds. And so a lot of people, I talk about this a lot on the channel. I say you have to do your research. You have to know about the stocks that you're buying. And a lot of people say, oh, investing in the stock market is risky. And I agree, it's risky if you don't know. What you don't know, if you don't know anything about the stock market, it's very risky. But I'm a very big proponent, or I always talk about investing. You have to do your research. You have to know the company. You have to know the CEO. You have to know the financials. I talk about that a lot on the channel. But I do understand that there are some people who don't want to do that. Don't want to research, don't want to deal with all the fanatics and all that good stuff. So today I'm going to be talking about ETFs, exchange trade funds, and why they're always a good go-to for people who still want to make money in the stock market, but you're not interested in the gimmicks of, doing all this research. Well, first of all, let me talk about what are exchange trade funds. So these are a collection of assets. And so these may be bonds, these may be stocks and stuff of that nature. Now, the beauty of exchange trade funds is that they're a collection of things, right? And so because they're a collection of things, they're not just one stock, or they're not just one company. And so the beauty of this is, if the stock market, let's say, is not very happy with tech companies and you have a lot of shares in a tech company, then your money is going to dip, right? However, if you have an ETF, right, and I'll be saying ETF for short, exchange trade fund. If you have an ETF on your portfolio, the chances of your portfolio dipping drastically because of one stock is very limited. Now, the way I talk about this in my book, A Toolkit for Raising Wealthy Kids, I compare this to, let's say you go to the market and you buy different fruits, right? And let's say you versus if you go and you just buy a bunch of the same fruits. So for instance, let's say you buy a ton of apples. I don't know, you want to make apple pie, so you buy a bunch of apples. As opposed to you buy some apples, you buy some grapes, you buy some, what do you call that? I don't know, kiwi, strawberries, right? So one basket has a plethora of fruits, right? Several different fruits. Now, if you bought only apples and then you hear something in the news that says, okay, this type of apple is no longer safe for you to eat, right? If it's no longer safe for you to eat, you have to throw away all of those apples in that basket that you bought, or all those apples, that one fruit, because you bought it, is now gone. But if you bought that basket with the several fruits and only the apples are bad, you just throw away the apples and you have the other fruits, right? And so your fruits may not be affected that much because it was one out of, let's say, 5 fruits that you bought. And so it's the same thing with the ETFs, right? If you buy a share or shares in an ETF or several ETFs, it depends, right? You can do just one or you could do several, because they really are a collection of stocks, and sometimes they're like the same area, sometimes they're not. If one stock dips, your actual share or your actual ETF is not like dramatically impacted, as opposed to if you only had shares in that one company, then all of your share value is going to go down. And so that is why a lot of people tend to go towards these ETFs instead of buying the regular stocks. Now, I will say there is a drawback. Before I talk about the drawback, I have to say thank you for tuning in. And well, this channel, we try to bridge the wealth gap by educating people about financial literacy and investing at that. And so if you've watched this far, we hope that you will take a pause, subscribe if you haven't subscribed already, and share this video with someone who is also on the journey of building their wealth and leaving a legacy. Now, the one drawback that I will say there is to ETFs is that they don't increase in value as a company or a share in a company would, right? And so I do have ETFs on my portfolio, dividend paying ETFs. So there are dividend paying ETFs, and I always talk about getting dividend stocks. So of course, I have dividend paying ETFs. And so the drawback there is when you look at increasing your portfolio rapidly over time, ETFs may not be the best bet, right? Because they are going to go up in value, yes, but it's going to take a while, maybe several years or something like that. But we always talk about when you are doing wealth building, it's going to be long term, right? And so if it's long term wealth building, it shouldn't be much of a problem, but it's really a safer bet. A lot of people talk about diversifying their portfolio, and this is the best way. I think you should diversify your portfolio. I do not think you should be buying a million different stocks. And I talk about this a lot in my free webinar that I have every other week. I strongly am against diversifying portfolios. And so I may have a whole whoop to do about that. But if you are the type of person, you're not interested in looking at numbers, you're not interested in seeing what the trend is, you're not interested in when to dip in and dip out and all of that, ETFs are your best bet. And they are more reputable as well, some of them, depending on which one. But you still kind of have to look at, well, which ETFs are good for me as a person, because it's not a one size fits all. So hopefully this was helpful for you all, especially in the market that we're currently in. You might want to look at ETFs if you are a little bit shaky in the investment piece and you want to dive in, but you're not sure if you should. ETFs are the best way to go.